Some people say that house prices double every 7 or 8 years, but you know, there are places in the UK where house prices have not risen since 2008. We're going to reveal them in this video, so stay tuned. My name is Ranjan Bhattacharya. Welcome to this episode of Property Breaking News. I'm joined as always on PBN by Andrew Roberts.
Thank you very much, Ranjan, for inviting me back. What a delight.
What a delight indeed. And then we are discussing this topic of house prices doubling every 7 years. We'll talk about the theory of that, and we'll reveal in a mo some towns where it simply hasn't happened since 2008. But first of all, if you're new to this channel, make sure you subscribe and hit the bell icon. We put out content each and every week, all dedicated to keeping you on top of your property investing game. So subscribe, hit the bell icon, like, comment, and let us know what you think about what we are about to say. Now, this theory, is it urban myth? House prices double every 7 years. Where do you think that all comes from?
Well, I don't think it is urban myth. We have to look at this house prices malarkey and sort of track what impacts on house prices. And to me, there's lots of different things. There's people buying houses for investment purposes, like we do. And there's people who buy houses because they need employment in an area.
Yes.
And then you get political statements like the levelling up policy of the government, which is about trying to balance employment and house prices across the UK.
Well, I thought levelling up was just about giving northerners high heels on the state, and that was pretty much it. But maybe that policy's got something else in mind completely. But I think you're right. But this whole doubling every 7 years is all about averages. All the statisticians have got all their spreadsheets and figured out that on average. On average, every person in the UK has 1.99999 legs. Because you only need one amputee in the country for that statistic to be true.
Well, everybody has 2.4 children as well.
Exactly, yes.
Which one of yours did you cut a little bit off?
So it's statistics, isn't it? So where is this statistical town where house prices are doubling every 7 years?
I think we need to look at some of the data, because if we go back to 2007, the average house price was 129,000. And then if we wind forward to today, the average house price is 279,000.
Yes.
Now, that's not a doubling, that's more than doubling. But then if we go to certain towns, and this is the bit that I really am struggling to fathom, because they're suffering from negative inflation in these towns. Hartlepool, that's the town where they've got a monkey for the football team mascot.
Well, I don't know too much about football, but this is the article we're commenting about is something in the Daily Mirror, and they've listed a couple of towns where property prices have not risen since 2008, and
better than that, they're lower than they were. Lower than they were by £3,000 still.
And those towns are
Durham and Hartlepool. So
So
the famous university town of Durham and the famous Hartlepool monkey that's out there are both worth less than they were. So,
and one thing is always worth doing is scrolling down to the comment section. I'm scrolling down to the comment section of this Daily Mirror article. Who wants to live in Hartlepool? It's full of horrible people. Are you a horrible person? Let us know from Hartlepool. Let us know in the comments below. That's always an interesting read, that is.
Yeah.
But this is a little bit of a problem, isn't it? Because there are a lot of people on YouTube and all of this out there who are advocating going to these towns and investing in property where there's no capital growth. What do you see as the downsides of doing that?
Well, I think there's a number of things. There's not only no capital growth, but there's negative capital growth, because we have this thing called inflation. And if the asset is worth less, 15 years on than it was when you bought it, then your money's actually decreased in value. So you might get a good yield, but you've got less money. You try and sell that property. The lead time to sell in those areas is 12 months or more for concluding a sale. So you're now locked into that property. And in terms of the area, you are likely to get more socially deprived areas because it's the lowest prices in the country. Now, what would be affecting the prices? Why wouldn't the prices be going up? Lack of employment. And if we look at the employment tables, they are some of the poorer areas of the UK. So your money is going down in real terms. You can't sell 10 properties in Hartlepool and come down to London and buy one flat, because each year the flat in London is going up exponentially versus going down exponentially in Hartlepool.
And people don't look at their returns properly, I think. I mean, the returns is, you look at the yield, yes, but you also look at the annualized growth through capital appreciation, and you join them together. And what you tend to find is that if you chase high yield, when you look at other areas with lower yield, and you factor in the capital appreciation they're getting, you're still down. But it's about balance, isn't it? I mean, I think, we've banged on about the North and all of that, and talking about high yield chasing, but it's also not great for buy-to-let to go in these really high value areas where yields are exceptionally low. I mean, we're broadcasting here from St Albans, and St Albans is one of the worst places in the country to do buy-to-let because the capital values are so high compared to the rental returns for residential buy-to-let. So really, it's about this Goldilocks zone. You know, it's about where it's not too hot, it's not too cold, the yield is good, but the capital appreciation is also there. I mean, is that what we're all looking for, the Goldilocks zone?
I think it is the Goldilocks zone, and could that be why we bought a commercial property in Leicester? Because it's a Goldilocks zone of a little bit of capital growth there, but also good rental yields.
Not too hot, not too cold. We've got a video. The video, if you're wondering what we're talking about, we'll put a link to the video there, and you can watch that at later time. But I think that's what people should need to look for, really.
Absolutely. It's about getting the balance right. And the other thing I think it's also about is not putting all your eggs in one basket. And I know a lot of people who invest heavily up north, but what they're doing is they're putting all their eggs in one basket. Now, if all of your properties are social housing and all of a sudden we have an economic boom, your social housing tenancies disappear. On the other side, if everything you're doing is to professionals in the city and we end up with an economic crash, their jobs go. So what you've got to do is have a little bit of a mix and match strategy where you've either doing a little bit for yields, but have different tenant demographics as well, because too much of one tenant is not good.
Tenant demographics is absolutely key, and I'm always been an advocate of making sure your property will appeal to multiple tenant types. So, like, let's say you're in a student town, and the only reason to be there is if you're a student. And if the university decides to put halls of residence over a few rugby pitches, then you're stuffed. You really need areas where you've got students, perhaps proximity to a hospital, perhaps proximity to a big retail park centre, that kind of thing, private sector employment, public sector employment. You need as many of those points, employment points, as possible to be in the close vicinity of where you are. And it also helps if you're close to transportation to take you to other places where there are employment prospects. And if you get all that right, you should be okay.
Yeah, well, I think that is the problem, and I mean it in the nicest possible way. People who are new into the industry often are enticed into, shall we say, a high return, or looking at things in a very narrow focus point of view. Now, on this channel, I know you put out a lot of videos which will help people actually develop their broader perspective and looking at the industry as a whole and business as a whole. So if you haven't already, 50,000 subscribers can't be wrong, so make sure you are subscribed to this channel.
You took the words right out of my mouth. Subscribe, hit the bell icon, and comment and all of that jazz below. One of the ways you can actually do well with the yield play and also the capital appreciation play is, of course, and I have to get this in somewhere, former commercial buildings. Because you take a commercial building, let's say a shop and uppers, and you make the upper parts residential. What you have is it doesn't rent. A flat above a shop will not rent for anything less than a flat in a fully residential premises, but its capital value will be slightly less. So therefore your yield will be more.
Correct.
And that's one way of squaring that circle in slightly higher value areas. You get the yield, you get the capital appreciation, and you can make your own Goldilocks zones through commercial conversions.
It really is a good job you said in the higher residential value areas, because I was just going to say, please don't take what we're saying as advice to go up to Durham or Hartlepool and buy a commercial property, because the residential values are so low, the cost of conversion will not make it economic for you to make money from.
No, it'll probably cost you more in diesel to go up to Hartlepool than the value of the property. But well, I hope we don't get too many unsubscribes in some of these comments.
Diesel? Do you not have a hybrid or electric car by now, Mr. B?
No, I mean, yes, I'm a petrol head. I'm not going to get one of those electrics in a long time. But anyway, so if you want to find out more about how to create these Goldilocks opportunities with commercial properties, converting them either partially or fully into residential use, we run a whole series of masterclasses. They're absolutely free. It's 90 minutes long. Take you through exactly how you can find and exploit these opportunities wherever you live, provided it's not Hartlepool or Durham, of course, but wherever you live, it's possible to exploit these opportunities. Join me on the next one. The link is on the screen below. Great story. Thanks very much, Andrew.
Thank you very much once again. I love debating these scintillating topics on commercial property.
And until next time, see you in the next video. High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.